the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements on the SGX. Well, Singapore shares dipped today as markets in the region traded mixed. So the Straits Times Index was down 0.31% at 3,811 points at about 1:32 p.m. Singapore time, and that is with a value turnover of some 569.5 million Sing dollars seen in the broader market. As we shared with you earlier, the STI ended in the red as well, ended down 0.31%, that level that we saw at about 1:32 p.m. Singapore time. So the number we're looking at, the closing number, is 3,811.8 points. In terms of value turnover, that's 1.12 billion Sing dollars. Gainers outnumbered losers, though, 243 versus 220. Top advances for today, we've got for you Penguin International, Jardine Cycle and Carriage, and ST Engineering. And top decliners, we've got for you UOB, iFast, and Asus. Now, in terms of companies to watch, we have Yangzijiang Financial Holdings, because Yangzijiang Financial is exploring the possibility of spinning off its maritime investment segment into a newly incorporated company to be listed separately on the main board of the SGX. Now, meanwhile, from Singapore's growth outlook turning more cautious in the MAS's twice-yearly Macroeconomic Report, to Airbus reaching that final agreement to take over some assets and sites from Spirit AeroSystems Holdings, we've got more economic and corporate headlines in focus. And joining me on a Monday is David Kuo, co-founder of The Smart Investor. Mr. Kuo, how are you?
I'm very good, Tian Tian. How are you?
Good. And Mr. Kuo, let's take a look at the Singapore stock market and whether it is doing good or not, okay? So how did the STI fare today? Any surprises when it comes down to the biggest movers and, of course, the sectors that they lie in?
Not entirely, Tian Tian. I mean, the market was down today. But again, I've always said, have a look at the market and just look at two groups of companies. The first one are the banks and the second one are the REITs, because they tend to move in opposite directions. And what happened today was that many of the REITs that people particularly like, such as CapitaLand Integrated Commercial Trust, and you've also got CapitaLand Ascenders, these did well today, whereas the banks didn't do particularly well. Then you have to go back and have to ask yourself, why are the REITs doing well and the banks aren't? Mm-hmm. And I think
interest
the general
rates.
feeling is that, exactly, yeah. And I think there is going to be some kind of monetary easing to some extent. And when that happens, it means that people like me who have my money in the bank and you are earning an interest, it means that interest is not going to be that high. And you have to go and find somewhere else in which to get the cash flow that you need. And so you therefore go and have a look at the REITs and say, well, generally they're going to do quite well. So therefore, I think that kind of sort of expresses the sentiment that people are feeling at the moment, that interest rates aren't going to deliver the kind of returns that they want, and so they're going to have to look at something else, such as the real estate investment trust again. And by the same token, if interest rates aren't going to be very strong, it means that the banks aren't going to do very well, and so you have this two-way pull on the market. But because the banks tend to be more heavyweight in the Singapore market, we saw the index down a fraction today. Nothing to worry about, but it was down a bit.
And Mr. Kuo, let's take a look at some companies to watch. We've got Yangzijiang Financial Holdings, because Yangzijiang Financial is exploring the possibility of spinning off its maritime investment segment into a newly incorporated company, and that is to be listed separately on the main board of the SGX. What will the move mean for Yangzijiang Financial's balance sheet, and how far are investors' reactions today justified?
I think it is probably sort of not such a bad idea, because if you have a look at Yangzijiang Financial, it is predominantly a fund manager. So it invests in a number of different enterprises in which it can actually sort of generate a return for its investors. But at the same time, it's got this maritime business, and it's saying that maybe, the maritime could actually do better as a separate entity. The maritime business does things like ship leasing. And I think the financial side, the Yangzijiang Financial, would much prefer to be a fund manager. And so, therefore, it's spinning it off. What will be interesting is when they do spin it off, how much of the maritime part will it keep, and how much will it actually sort of allow private investors to invest in as a separate entity? And that will determine what the balance sheet subsequently will look like. But I think having two entities, having the maritime business doing ship leasing is probably not such a bad idea. And then on the other side, you get this boring company that just invests as a fund manager, and then it collects whatever returns from that. And I think, investors can then decide, do they want the boring side, the financial side, or do they want the slightly more exciting, volatile side, which is the ship leasing side? So people can then decide. It's a good move.
And another company that we want to keep our eyes on, Mr. Kuo, is ST Engineering, because the group announced today that it secured new contracts worth about 4.4 billion Sing dollars in the first quarter of 2025. How significant are the numbers for investors today?
Well, the shares were up about 1.6, 1.7% today, and as a shareholder, I am delighted. But I'm getting a bit of height sickness at the moment, because I have a look at ST Engineering. It just seems to be going in one direction, up. And part of the reason is because of the defense side. People see it as a defense industry, and we know that there is a lot of turmoil around the world right now, and that is probably part of the reason why people are piling into ST Engineering. But let's not also forget that ST Engineering does other things as well, apart from the defense side. It also does things like urban renewal, and what it highlighted today was that all three arms, all three parts of the business did pick up increasing orders, and that probably justifies why the shares are actually moving up at the moment. But people need to actually sort of be a little bit more aware and have a look at ST Engineering and say that does the earnings that are going to be coming through justify the price that you are paying for ST Engineering right now.
Now, if you're just tuning in, we're in conversation with David Kuo, co-founder of the Smart Investor. While Mr. Kuo staying in Singapore, Singapore's growth outlook has turned more cautious, again, as U.S. tariffs hit the country, not just directly, but also through the impact on regional neighbours and global confidence. So if we look at the MAS's twice-yearly Macroeconomic Report, the MAS said the Republic's external-facing sectors will be most affected. It reiterated the official full-year growth forecast range of 0 to 2%, but noted significant uncertainty over how trade policy actions will unfold. Any thoughts on that, especially when we read this review against the latest, together with the latest unemployment numbers out today? Okay,
I would be very surprised if it had said anything different to what it just said, that the growth is going to moderate considerably. And it just goes to show how disruptive the tariffs are going to be. And I think as far as Singapore is concerned, whatever manufacturers are in Singapore, they're going to be very cautious, and they're going to say, do I really want to invest at the moment? Do I want to take on more workers? And what we saw with the payroll numbers was that there was some softening as far as the number of people in work at the moment. We're not at a disaster stage right now. Certainly we are not seeing massive layoffs in Singapore, but I think companies are being a little bit more cautious. And that is only understandable, Chua Tian Tian, that if you don't know what is going to happen, why would you want to sort of take on more workers? So I think that also highlights what was happening in the stock market today, because part of the reason why we actually saw this two-way pull on the Straits Times Index, with the REITs going up and the banks going down, was because there is probably going to be more monetary easing here in Singapore, and in that sense, the banks will still do well, but they're not going to do as well as they did previously when interest rates were high and they could make a lot of money without putting in a great deal of effort, because that net interest margin was there. But at the same time, it means that things like the real estate investment trust will become increasingly more attractive for investors, because that is where they're going to be getting a lot of their cash flows from.
No. Mr. Kuo, we talked about bank shares and how we're seeing a bit of weakness over here, but it doesn't seem all to be negative, right? Because Singapore lenders, apparently they are taking advantage of the recent weakness in share prices to purchase stock and making up the bulk of total corporate buybacks that are said to be the biggest in Singapore in 4 years. So if we go by data compiled by Bloomberg, the value of buybacks by DBS accounts for nearly half of all the stock repurchases in Singapore from the 1st of April to the 23rd 3rd of April. That is followed by UOB at 25% and then OCBC at just over 8%. What do you make of this, and what does this mean for investors? Again, back to the same question.
Okay, can I let you in on a little secret, Tian Tian?
Sure.
I bought some banks today. I bought some bank shares today because they just look quite cheap at the moment. And I think as far as the banks are concerned, they also think that bank shares are probably quite cheap at the moment. Mm-hmm. And many of them are committed to buying back their shares. And buying back the shares is good for investors. It just is a different way in which they can return value to shareholders, because the fewer number of shares that are out there, it means that whatever dividends they pay, the dividend per share will be stronger. And also the earnings per share will be stronger. Whatever profits they make, there's going to be fewer shares around. So that is going to also benefit shareholders. And the best time to buy bank shares, as far as the banks are concerned, is when the share price is low. You don't really want the banks to go out and buy back the shares when the shares are very high, because then we will criticize them and say, why did you buy the bank shares when they were so expensive? Surely you want to buy them when they are cheap, which is precisely what they are doing. And I think the long-term outlook for the banks in Singapore is still quite solid. We are not going into any kind of banking crisis. And I think that for long-term shareholders, people who are looking for the next 5 or 10 years, there is nowhere better than to actually sort of buy some Singapore bank shares, which is why I bought my bank shares today, Tim.
Okay, now further away, Mr. Kuo, I'm not sure if you'll buy U.S. tech shares because all eyes are on corporate earnings out of the U.S., including from the Magnificent Seven players, Meta, Microsoft, Apple, and Amazon. At the same time, we've also got a slew of economic indicators out of the U.S., including the Fed's preferred inflation gauge, the PCE price index for March. How would you prioritize what to watch and perhaps what to buy?
Well, I think the tech shares will take care of themselves. I mean, at the moment, nobody particularly likes the tech shares, so that is why they are coming down in price. But that PCE data is going to be really interesting, Tian Tian, simply because Donald Trump used it as an excuse to have another go at the Fed chair, Jerome Powell. I think the PCE data is going to be weaker, right? So I think it will indicate that the Federal Reserve's preferred measure of inflation is going to moderate. And when that happens, then you are almost guaranteed to have the president come out and say, "Oh, I told you so. The Fed should have actually sort of cut interest rates the last time. Why don't they cut it again now?" And I think we're going to go through this merry-go-round once again between the Fed and the president. The president wants lower interest rates, and the Fed says, "I'm not entirely sure what is going to happen," but it's still above the 2%. That is the target or the minimum that the Federal Reserve is looking at. So I don't think there's an awful lot to say about that, apart from the fact that there is going to be this argument between the president and the Fed chair. But the companies that I will be looking for are things like Coca-Cola, Tian Tian,
and McDonald's.
And McDonald's and Visa, because I think they will give me a better indication about what is happening in the American market right now. And we already heard from companies like Procter & Gamble and Pepsi saying that they're lowering their profit forecast because they are very concerned about the American consumer. So those would be the companies that I watch. And also I'll keep an eye on the tech shares just to see how they're coping with these tariffs right now. But it's going to be an interesting weekend, and people should stay tuned to what is happening with American earnings, because it's going to be a big earnings week for everyone.
Yes, certainly. I think 100 and over 180, or is it 180 out of the S&P 500 companies reporting?
I know I'm going to be up all night, Tian. I might as well not go to sleep. I'll just put the coffee on.
All right, and finally, before we let you go, Mr. Kuo, let's have a look at Airbus and Spirit AeroSystems, because Airbus reached a final agreement to take over some assets and sites from Spirit AeroSystems Holdings, clearing the way for the struggling U.S. aerospace supplier to be acquired by its former parent, Boeing. Any initial thoughts on this front? Yeah, well, I think this is finally going to put Spirit out of its misery, because Spirit was on the verge of bankruptcy. Yeah. And part of the problem was some of the fuselages that it built
We all know about that disaster where one of the doors blew open. I mean, that was all on Spirit's door. So I think what is going to happen now is that Airbus will take the bits that it wants, and Boeing will take the bits that it wants, and then Spirit will no longer be around. So I think this is a good thing. But it just goes to show how incestuous this relationship between the aircraft manufacturers is. They all rely sort of on each other. And whilst there is this very, very healthy rivalry between Airbus and Boeing, Spirit is caught in the middle there. So I think it's going to be a good thing. Boeing will get what it wants, and Airbus will get what it wants. And I think the future for the people who work at Spirit will be more secure, rather than having to look over their shoulders, wondering if they have a job tomorrow.
I see lots to watch indeed. Thanks so much for the insights, Mr. Kuo. That was David Kuo, co-founder, The Smart Investor. Thank you so much for joining us on Money FM 89.3.
Thank you.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.